Hi there, Chuck Gibson from Financial Perspectives in Pleasanton, California. Happy New Year! I hope everyone had a great holiday season. I know I did, but it's now time to get back to work. This month, I'm going to attempt to quickly summarize the year in charts, hitting on just the major trends. Because we may be at an inflection point, I've included some fundamental views too, as I like to use them to help confirm what I'm seeing technically. I have lots of charts and apologize for the quick pace I'll be on, but to get it all in, I'm going to have to move fast. I got lots to cover, so let's get right to it. The major theme for 2015 was the continued strength in the US dollar. As you can see in my first chart, the dollar was on a tear in 2014, and then eventually topped in March of 2015, and has been range-bound between the red upper and lower channels for the balance of the year. Technically, this looks like a bull flag with the potential for another big leg up. A confirmation of this would be a break, backtest, and a hold above the upper red resistance line. Of course, strength in the dollar should be reflected by weakness in other currencies, which was seen in spades. In my next chart, you can see how since the middle of 2014, every other global currency has been impacted. Some have been absolutely creamed. At the extreme end was Russia, losing more than 50%, while the Chinese yuan fared the best, only losing 4%. The euro and the yen, the only other real threat to dollar supremacy at this time, lost a noteworthy 20 and 16% respectively. Global currency decline can be related to both a strengthening of the dollar and or a weakening of that currency. There are many ways to weaken a currency, but expansion of a country's balance sheet is one being used around the world at this time. In my next chart, you can see how Japan and the European central banks have ramped up their balance sheets about the same time the US has begun to level off from their huge 2008 takeoff. Another way to weaken your currency is to lower interest rates, driving investors towards those with higher rates. This path is clearly reflected in my next chart of major global central bank policy rates. As you can see, everyone but the US and Brazil have cut their rates, some actually going negative. Now, I'm sure you're tired of me saying this, but the thought of negative interest rates blow me away. And yes, it does mean they charge depositors interest for keeping their funds rather than the other way around. It appears that wars are no longer just taking place with weapons to kill people, but instead trying to harm them economically, a form of a slow torture. And speaking of interest rates, I would be remiss if I didn't mention this in the 2015 recap, the fact that the Fed increased rates in December. For the first time in more than 7 years and rates stuck at zero, they inched them higher by 0.25%. Considering all the drama, the volatility, and the incredible overreaction that took place, I have to laugh when I look at the chart because when looked at in the context of history, you have to wonder, why all the hoopla? A little closer to home, the strong dollar has done wonders to continue the deflationary push, as commodities, priced in dollars of course, were once again absolutely decimated in 2015, as you can see in my next chart. Beef, off the least, fell 22% from all-time highs, while natural gas has lost an unfathomable 85%, followed closely behind by nickel at 84%. My next chart, that of the CRB Commodity Index, which was introduced originally in 1958, was designed to provide dynamic representation of broad trends in overall commodity prices. As you can see, it has been in an impulsive and strong decline, losing 35% in the last 16 months. Some might want to view this as a positive, as it should mean lowering prices to consumers, but central banks' enemy is deflation, and they will do anything and everything to defeat it. Hence, the continued printing of money and the bizarre experiment of pushing interest rates negative. A rising dollar creates strong headwinds for U.S. multinational companies doing business abroad, as it makes their products cost more to local currency customers. That's being reflected in a decline in their sales growth. As you can see in my next chart, a look at year-over-year growth of the S&P 500 companies, we can see that not only has it been slowing, but it has turned negative. It should come as no surprise. This is why we've seen little strength in the U.S. stock market since the second half of 2014. My next chart of the S&P 500 shows we've been range-bound between the upper red resistance level and the lower red support line. In addition, the blue rounded top reversal pattern I drew in June of last year still continues to be in play. Finally, it's important to note each time prices moved above the red 200-day moving average, it gets rejected, which has allowed the moving average to now flatten and begin to point downward. My next chart is a look at market breadth. This shows the number of stocks above their 200-day moving average, which is a reflection of market strength. In a healthy market, you want to see this number above 80, and we are less than half of that right now, just above 30%. Must also point out that the red 200-day moving average is pointing southward, reflecting a strongly bearish trend is in place. You might be wondering why, if the market internals are so weak, why hasn't it fallen more than it has? The answer, of course, it's easy. It's FANG. That's the acronym for Facebook, Amazon, Netflix, and Google. These and a few other companies are keeping the indexes afloat, while nearly 60% of the rest are in a bear market. In my chart, from top to bottom, are Netflix, followed by Amazon, then Google, then Facebook, and at the bottom is the S&P 500. You can see how well these stocks have done in 2015, and because of their market cap, have done a yeoman's job of keeping the market propped up. My last chart is one that I don't show too often, but it's one that I use weekly, as it's a part of my investment process. It's a chart of the Fed balance sheet versus the S&P 500 price. The correlation is so strong and undeniable that it has to be given an investor's full attention. As you can see, the Fed stopped expanding their balance sheet late last year, and as such, the S&P 500 has flatlined and also been through a 12% correction. Until we see the Fed ramp back up some version of quantitative easing, or whatever the new name's going to be, I suggest there is no reason to be fully invested in the U.S. stock market. This information, combined with the technical damage done, dollar strength, and bond weakness, has me with the highest level of cash in clients' accounts ever. To wrap this up, I wanted to mention that, depending upon your interpretation or bias, what I'm presenting here can be viewed as either worrisome or as a fantastic opportunity. This is why having a process that eliminates bias and opinion is how best to deal with markets and consolidation. Since it can only go one of two ways, during times like this, I've learned it's best not to overcomplicate it and instead listen to the market and wait for its signal. The good news is I don't think we'll have to wait too much longer, as I expect it to show its hand in the first quarter of the new year. Well, that's it, and in record time no less. As always, I appreciate your time and attention, and I hope you found this video helpful and informative. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with December's Charts on the Move.